Blackstone, one of the largest financial institutions the world has ever seen, has just stopped its investors in its flagship real estate fund from removing money in an attempt to stop a bank run that would without a doubt be disastrous. The fact that this company is panicking and freezing withdrawals has sent shockwaves across the industry, with millions of people wondering just how bad it really is behind the scenes. There are $125 billion immediately at stake here, and trillions more if this crisis should expand and impact other institutions connected to Blackstone, and yet the media is hardly even talking about this, and if you don't read Bloomberg or CNBC, then you probably didn't even know this was happening. This video will change that, as I'm about to explain exactly what is happening, why it's happening, and what we might be about to see. But firstly, what is Blackstone? Because it's probably a name you've heard, but most people don't actually know who they are. Now, Blackstone is a financial institution that invests capital on behalf of its investors, but it does so on a massive scale for pension funds, large institutions, or the mega rich of the world. Their biggest customers may be billionaires and the elite whose names and faces we don't even know, but their most numerous customers are ordinary Americans who just so happen to have a pension scheme wrapped up in this monstrous company. There are 31 million pensioners who rely on Blackstone for their income every single month, and the company controls just under $1 trillion in assets under management. But to clarify very briefly, Blackstone is not BlackRock. The two are similar, yes, and they have a shared history and a weirdly similar name, but in this day and age, they are actually entirely different and competitors with each other. Now, one of Blackstone's flagship products is a real estate investment trust, or a REIT, called BREIT, and it controls about $125 billion worth of property in the United States, and its mandate is very simple. Take investor capital, buy various types of property from single-family homes and apartment blocks to warehouses and farmland, rent that property out, and distribute those profits back to their investors. As one of the biggest property owners in the entire world, it's safe to say that they've done okay over the last few years, especially as property prices and rents in the US skyrocketed in the post-COVID economy, but that started to change as investor sentiment has been deteriorating, the world is falling into a major recession, and property prices are looking precariously on a knife edge. About a week ago, we started getting warning signs that things aren't so great in Blackstone, as this letter here was sent to investors that explained the REIT was having a few problems. Blackstone basically just told their investors that they're limiting redemptions from the REIT, meaning that people aren't allowed to take out their money anymore, no matter how badly they need it. Over the month prior, the fund had seen its previous withdrawal limits of 2% per month and 5% per quarter maxed out, and as a result, they were having to refuse investor requests to give them their money back because they couldn't pay it out. To make matters even worse for Blackstone, these investors aren't like you and I. Yes, they include pensioners, but they don't even know that Blackstone has their money. Blackstone works with institutional clients, billionaires and businesses, not normal people like you and I, and this REIT is one of their flagship products that holds over 7% of all of their clients' assets. These clients have to be invited into this fund and no one turns them down. So for Blackstone to be now going to these investors hat in hand and saying that there's a problem, we know that there really is a problem, and it's not a small one at all. So why is this happening? Why is there the start of a bank run starting to pop up in real estate of all places? Well, the fund has actually had a really strong performance that hasn't actually slowed down yet. They've returned an average of 13.1% to their investors over its entire history per year, and over the last year alone, they've returned 9.3% to their investors at a time where, let's not forget, stocks have been floundering and investors like Cathie Wood have totally crumbled under the pressure, losing their investors tens of billions of dollars. And yet, despite these pretty incredible results, investors are leaving the fund anyway and asking for their money back, leading to a liquidity crisis within the fund and forcing them to just refuse to give people their money back. But here's the thing, housing and property prices are what we call lagging indicators. That means when we see a cycle where property prices fall, they tend to fall after the problems emerge instead of before. Property prices are slow to react to changes in the economy and monetary environment because it takes a long time to actually transact. It can take months or even years for a decision to buy or sell a property to be made, and then comes the task of finding a buyer or a seller, negotiating the deal, acquiring financing, and finally closing, which can also take months or years. That means that it takes years for a housing market crash or boom to emerge as well, but it also means it's very easy to predict what's going to happen next with the housing market, and that's what these investors are doing. They are watching average rents in the US fall in real time, from above $1,700 at its peak to just above $650 right now, and they expect this trend to continue. They're looking around at the economy and they've come to the conclusion that this is the top for property prices and they want to cash out now. They think property prices are finally going to start coming down and they see no reason why they should keep their money in a vehicle dedicated to tracking property prices. Of course, it doesn't help that the cost of debt is rising, with the all-in price of floating debt for multifamily rising up to 8% so far this year, more than twice what it used to be. Blackstone's REIT, in case you were wondering, is predominantly holding multifamily housing and it's currently holding about $50 billion worth of debt. And then there's the fact that commercial property prices are already falling in comparison to their rents, with a 5.4% cap rate right now compared to a 4.8% cap rate at the end of 2021, implying that commercial property prices have actually already started to decrease. This is very bad news for Blackstone, and it's coming after a very bad year for the company as a whole. In the first week after this news was announced, Blackstone's share price has fallen by over 14%, and the stock has now lost over 40% of its value over the last year. It's safe to say that things aren't going to plan at Blackstone, and the markets are finally starting to react. Just a few weeks ago, they announced they were selling the MGM Grand Las Vegas and Mandalay Bay Resort casinos for $1.3 billion, and people are starting to ask if that decision had been driven by a desperate need for cash that they didn't fancy telling us at the time. The other major fear here is that there may be some funky accounting going on behind the scenes that explains Blackstone's huge successes over this last year, and investors may be jumping ship before the iceberg strikes and reality is exposed. The underlying problem is that Blackstone have decided that the properties they own have been going up in value faster than other REITs in the markets. Now, it is just possible that Blackstone are simply better at investing in property and they manage to pick the better properties for appreciation than their competitors, but it's also possible that Blackstone's private nature has just allowed them to simply lie about their strong performance in an attempt to hold on to the capital and the investors that they have. It's not at all unheard of for financial institutions to see their fraud exposed during times of market turmoil, and we've already seen this happen this year with FTX's collapse and fraud just over a month ago. The question many people will be asking right now is what's next, and unfortunately this is where I have to disappoint you because I just don't know for sure. On the surface, Blackstone is fine and totally solvent, even if their share price has been dropping like a rock and investors have been running away. But during the 2008 global financial crisis, we saw institutions just like Blackstone collapse overnight when no one thought they would, or as Jim Cramer would say,
Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no.
Is it really so crazy to think that something similar might just happen this time around as well? The stance that most analysts are taking here is that this probably isn't that big a deal, that Blackstone is probably fine, and that this probably isn't any kind of Lehman moment. And actually, I agree with that sentiment for the most part. The problem is that Blackstone isn't the only problem right now, and it doesn't exist in a bubble. Yes, this news on its own is not even close to being enough to crash the market, but these kind of stories are popping up left, right, and center. China is on the brink of the worst recession in its history, Europe is suffering under sky-high energy prices costing them trillions of dollars, tech companies are firing tens of thousands of employees like it's nothing, and the US was literally in a recession for 6 months. Blackstone alone isn't going to crash the economy, but when the economy does crash, Blackstone just might fall with it. There's also the simple fact that property prices in the US are going to decrease because they are innately connected to debt and thus interest rates. When the vast majority of property in the country has debt on it, interest rates rising means that it gets more expensive to own that property, and thus the return you can make from owning it decreases, and so does the property's value. There is no way around this, and as we all know, interest rates have been rising for almost all of 2022, and according to the Federal Reserve, they're not going to slow down or stop anytime soon. This means that Mr. and Mrs. Jones, who have saved up a deposit for a home and are ready to buy, are going to have to spend more money month to month on their repayments, and so they can't afford as expensive a home as they could a year ago. This means that those who already own property with variable rate debt on it are going to see their repayments increase too, and some people will even have to sell their homes at a loss to prevent them from failing on their obligations. Demand will fall and supply will rise, and anyone with even the most elementary understanding of economics can tell you that that means one thing for property prices, that they're going to go down. Whether or not Blackstone's REIT will survive is another thing all on its own. Whether or not Blackstone as a whole will die is up in the air, and whether or not that will cause contagion and a repeat of the 2008 global financial crisis is a question no one can answer today. But red flags have been raised, alarms have been sounded, and it isn't looking good. If you want to make sure you stay up to date on this story, then subscribe to the channel, like and comment to help us spread this message out to more people just like you, and until next time, stay stoic.